Welcome to our first Fractal Wave webinar. So this is a project that's been in development for several years. There's been a team of 5 of us involved with this project, but we've got the 2 key players with us today. We've got Dan Winter in South France, and we've got Meryl, who lives over in California, and my name is Roger Green, and I'm the director of Breakthru-Technologies. I'm also the business development person for Fractal Wave. So the idea of this webinar is to give you an introduction to the Fractal Wave stock market analysis and what's unique about it. And we want to start with essentially kind of interviewing Dan Winter first, because all roads lead back to Dan Winter with this project. He's the one who got us really infused about it. And then the second half of the webinar will be interviewing Meryl. Meryl's been our amazing programmer, and of course he's the mathematical genius, and he's the one with the PhD. The rest of us are just like, you know, crazy with numbers. So, and I've got a presentation that I'll get live and share with you, just to give this webinar a little bit of structure. But before we begin, I'd like to just say hi to Dan. And Dan, if you could just give us a little bit of your background.
My graduate work was in psychophysiology after undergraduate degree in electrical engineering, University of Detroit. And then I was a systems analyst with IBM for some time. Just talked with Meryl about that. And then I ran an electric motor business for many years. I was involved in a Gurdjieff school in West Virginia, started a community in North Carolina, and lectured all over the world for 20 years, and a lot of work in France and Australia. A bit of a long story. Fractalfield.com is many links. Many people know me. I'm happy to be here.
So you're very famous for introducing the world to concepts like heart coherence, and you were one of the pioneers of biofeedback back in the 1980s and the 1990s. And you also produced the eye tuner, the heart tuner, and the brain tuner. Can you tell us a little bit about those early days with biofeedback?
Well, in graduate school, I was the designer of the polygraph, and I was impressed at how fast the polygraph GSR, galvanic skin response, could see when you showed Playboy magazine to an undergrad's male. So I thought, instant response. And I was very interested in psychophysiology for a long time. And so I began to get involved in biofeedback. I pioneered a system at Millard Fillmore Hospital in Buffalo. We were measuring the heart harmonics to correlate to emotion. And we had actually famous at the time, Foster Perry. He said, "I'm sending love to the children in China at the moment. We are spectrum analyzing, taking the harmonics of his heart." And we got this beautiful coherent cascade of harmonics. So just when he said, "I'm sending love," I thought, oh, that's so cool. And later, Heart Math Institute, of course, got a hold of that and flew me out there several times, and I tried to teach them. And there's controversy, long story, but we really believe we've come to understand the meaning of heart coherence. And we've applied that to brainwave harmonics. We have about 7 apps on the App Store right now. At that, first it was Heart Link, then it was Heart Tuner, and then it's iThrive.com. Well, no, then it was HeartsRing.com, which was the first app on the App Store. And now our apps, leading ones, are iThrive.com, iThrve.com, which is probably the most sophisticated heart rate variability app in the world, and chakras, iThrive chakras, and related apps, and then a breathing tuning app, and also our brainwave app, which is state-of-the-art for brainwave meditation, flameinmind.com. So there's a lot to that story, and we're having lots of fun.
Well, I remember back in the late 90s when I got involved with you, and for those who don't know it, I started to sponsor Dan's work in Australia, and Dan and I have done dozens and dozens of events, from sacred geometry and spirituality retreats and tours, and the meeting of spirituality and science. And I remember saying to you many decades ago, can this be applied to the stock market? And of course you said, of course it can. right? And fortunately, we were able to meet up with Merrill later on to do some serious programming for this. But I'd like to take folks through some of the, the big concepts that we're involved with here. So in your early days with pioneering biofeedback, you were using the golden mean ratio. So can you just tell us a little bit about your definition of the golden mean ratio, and then how you started to apply it to biofeedback mechanisms?
Well, yeah, I think if you don't mind, I'd like to start with how waves emerge from chaos. That's the sort of key here. And, the stock market's a wave, obviously. And if you're looking at volume or price, and you can graph that, and you get these beautiful waves. And there's lots of people worked on it, and Breakthru and Elliott wave talked about golden ratio. But our way of looking at the wave mechanics started with the heart. It's true. If you take a harmonic series of what the heart or the stock market is doing, the moment when those harmonics in what's called Fourier transform spectrum analysis, power spectra, those are the technical terms, it's just the frequency signature graph. And when you look at those harmonics, when those harmonics are tall and organized, then you see that the heart is becoming coherent. And initially, that's what, and the controversy was of how you quantify that coherence. And that's how I was credited in literature for inventing the term heart coherence, because I invented the mathematics to measure it, called a cepstrum, a second order power spectrum, the technical term. It's just a power spectrum of a frequency signature of a frequency signature. But anyway, so the point is that when a wave system like the heart is becoming self-organizing, what medicine now knows is, quote, a healthy heart is a fractal heart. And what they mean by that is harmonic inclusiveness. Now, it turns out that to include the maximum number of harmonics in a single oscillator, physics proves that the golden ratio is the solution to that problem, because it makes the compression of those harmonics electrically non-destructive, which is, say, constructive interference. Implosive, fractal, literally. So golden ratio optimizes fractality. So in that sense, we can recognize the heart's ability to stay out of chaos because it's fractal, and that's medically well known. But I've evolved the mathematics of that based on golden ratio and fractality, and we call that golden ratio the conjugation of phases optimized, called phase conjugation. So that's a little background. Then, so I was having fun with that in biofeedback for years and years, and that was 3, 4, and deciding to apply that to the stock market. I was looking for the mathematic wizard, and I met. Actually, Merrill's wife's grandfather, was it? And he started telling me about what a genius Merrill was, and I was looking for mathematical genius here. And so, because what I wanted to do, think about this. Here's the stock market. You've got this, in the heart, we were looking at frequencies about 1 to 20 hertz is where you got the love effect. But in the stock market, we're looking for waves that take days, but it's still the same physics. You want to see when that wave emerges into order. And the amplitude of that peak in the power spectrum, frequency signature, indicates the amount of coherence in that wave. And then calibrating how to make thresholds for that amount of order to predict when the next wave is going to be predictable took a lot of tweaking, and that's Merrill made a huge contribution there, obviously. Anyway.
Can you tell us a little bit about the early days too with Phi the movie? It's quite a cult following, Phi the movie, and you were actually involved with it as a consultant in the early days, weren't you?
Actually, lots of people think my life story was the inspiration for Phi the movie. First of all, it's a horrible movie. Second of all, it should have been called Phi. In fact, whatever director tried to change the name did a horrible disservice. But it's true that everybody would chase someone who actually knew how the stock market emerged from chaos. And that's the theme behind Phi the movie. And of course, my picture is on the website, or was, and long story. It's not the only film that was supposed to be based on my life. When Brett Leonard, Stephanie Sutton Dearborn, Pat Flanagan's wife, whom we knew a long time, introduced Brett Leonard to me. He made film Lawnmower Man, which was supposed about me, which was supposedly about the Flame Letter, which had been called Flame in Mind, which is actually flameinmind.com today. And in both cases, it's about how, if charge density comes to of focus implodes, it creates information density. And that creates negentropy, self-organization, how to emerge from chaos. And in biology, I mean, Kundalini is that. And so when the guy drills a hole in his head in the Pi the movie, a horrible way to, actually, it's a metaphor for what Kundalini does. It feels like a lightning bolt, and it's true. So it's a bit of a long story. And the history of making this in a movie, I think they did a terrible job, actually. But yes, we got a bit famous in that way.
Right, right. Well, moving on, I think most people to a degree are familiar with the chaos theory. You know, it's a branch of mathematics that looks at the behavior of dynamic systems that are sensitive to, you know, small conditions. Small conditions will have, you know, an outcome on larger patterns, hence the butterfly effect. Can you tell us a little bit about, you know, how this whole concept of the chaos theory? Hey, Bruce.
Well,
Bruce, by the way, Bruce, you've come in as a host, so you might want to just mute your microphone a little bit there, Bruce. So carry on, Dan.
well, yes, I mean, chaos theory is the right question, but I don't think conventional literature has the right answer. And in fact, my book, Origin of Biologic Negentropy, fractalfield.com, claims to have the answer, Planck times integer exponents golden ratio, the perfect Caduceus conjugation. So that being said, what chaos theory wants to do is to say, you know, if you understand chaos well, you can predict when self-organization is going to occur. Now, I was just discussing with Meryl minutes ago that I think, you know, the elephant in the room of science is, you know, the scientists are standing around quite arrogant saying we have saved civilization, when in fact they don't have a clue why objects fall to the ground. That's an elephant in the room. And another elephant in the room is the fact that physics has measured many times self-organization out of chaos when lasers converge, called phase conjugate optics. So negentropy has been measured, but no physicist is even brave enough to ask the question how that happened. Well, I have answered that question, which is to say implosive charge compression based on phase conjugation golden ratio to Planck. And that is charge implosion, that is negentropy, and that is the origin of all centripetal forces. So I feel very strongly about that, and that's what fractalfield.com is. And by the way, we're successful. So anyway, my 2 cents is now in. It is based on golden ratio, exactly.
Meryl, it'd be good to hear your thoughts just essentially on, you know, the chaos theory and, you know, the patterns of numbers and fractals and golden mean ratio, etc.
Yeah, I mean, you know, there's a lot to it, right? It's not there. It's not imaginary, right? And so yeah, so we took so I met Dan when I used to live in France. Before that, I worked for I did some actually one of the first algorithmic trading hands-off systems in Chicago. Traded live there for a decent sized fund. And then in 2008, we moved to France for 3 years. And that's where I met Dan, as he mentioned, through my wife's grandfather who was meeting Dan. So yeah, so fractals, I mean, there's chaos there, you know, there's tons of literature on this. Yeah, it's very interesting. It affects, you know, basically pretty much everything. You know, it's not always, we're not always converging and whatnot, but the idea is to find out when things start to take hold. Right?
I mean, so if you take that fractality, golden ratio times Planck, integer exponents, you get hydrogen structure very directly. That's new information from me, and in addition to planetary orbitals and photosynthesis frequencies and all the biological oscillators that emerge from chaos. So this ability to implode by perfect fractality, which is by mathematically known to be perfect compression, is that origin of negentropy. Now that's the big background, that's the big picture here, and it's a beautiful, powerful picture and a good way to start. However, what we then did with Meryl in applying that to what is fractal wave software was quite a bit more mundane, actually. We were simply looking at the amplitude of primary peaks, which is a pretty basic mathematics, and You know, so Merrill and I sort of got that going at the beginning. But then Merrill did years and years of detailed work setting thresholds to see when that, if, for example, if a 3-day wave shape reached a certain wave of amplitude of coherence, then the next move was going to be predictable. And figuring out what those thresholds were, that's what Merrill spent much time on and beautifully did. And now we have success, so it's very cool.
And I, you know, I had a lot of years in working with, you know, the financial markets, and, you know, my background being mathematics, physics, and I've been a software engineer, architect since, you know, after college. Started in the software industry and been in there ever since. So I took, you know, basically my interest in mathematics that I've been working in the field for a while, and took that, what I already knew of how the markets work and all the difficulties and all the different things, and then basically put it together, you know, built a whole infrastructure to run the analysis, to put things in that I knew were important, combined with, you know, the original, you know, spectral analysis, you know, Fourier transform, sine waves, and predictability, and all these different things, combined with some other things that I know from my work in financial markets, and built the whole, you know, database, software analysis, everything. And then once I came up with, yeah, this is the right mix of things, then basically I built it out into the cloud, you know, using the various technologies to essentially programmatically and automatically every single day analyze the stock markets to say, hey, what's happening? Is there anything that is manifesting that, hey, this might be a good or a potential profitable trade, right? And so that's where that work comes in. And this is what he's showing right now. Roger's showing, like, this is an example of an email that will get sent out every day. I mean, not every day there's something that says, hey, yeah, here's a trade coming up, but we're, you know, what, 20 or 30 usually a month, typically a month, that come out. And so essentially,
well, there's Merrill, just to be correct here, there's, you know, approximately 20 signals with 13% anticipated move of stock. You know, we've got a few more that are, you know, from a range of, you know, 3 or 4% upwards, you know.
Well, yeah, but no, the 13% is actually a lot less than that. It's only about 4 or 5 a month.
Oh, yeah.
Yeah, those are the highly profitable ones. And yeah, so what's different about this? What's different about this compared to let's see, yeah, probably could be, but we haven't run that through. What's different about this than a lot of other systems is, one, before you actually get in, it'll tell you how long, when the exit date is, right? Because we extrapolate that based off of the cycle length, right? It says, oh yeah, well, this is the expected exit date. Now, that doesn't mean that the systems always maintain their cycles, right? But given in the cases where they do, that's the expected exit date. So there's basically a 2, and it also gives you your target exit price, right? It actually gives you the price that you should put in to exit. And then whether it meets that, if it doesn't meet that, then you should get out by that date, because at that point, by that date, that's the end of the cycle. And if it didn't hit that, then, you know, obviously it didn't go through. But depending on the percentage rate, which comes out in the email, I mean, if you're looking at a 13% anticipated move, you know, that over time, historically, which has been a fairly robust analysis, you know, you're looking at about a 73, 74% win rate on those. Ones and less than that, anywhere from 64% to 68%, depending on the percentage. That's your expected win rate. You need to have a 5% stop is what it's calculated with. So
yeah,
if
I've
it
got
does,
some of those results from 2018. I just want to do a little review for folks of these signals. So first of all, the software basically crawls through the three major stock markets from New York. So we're just based in New York at the moment. Yes, in the future, we'd love to be possibly doing other stock markets, but at the moment, it's just the three major stock markets of New York, and they're the most important in the world anyway. And so as you see on the screen here, we send you the signals to your email, and this is an example of what you get. So the first column there is the symbol of the stock, and then the anticipated entry price, and that's from memory, Meryl, that's within about 24 hours of getting the signal, isn't it, that this anticipated entry price would be
anticipated entry price it's based off of the close of the day before, right?
Yeah. And then you can see that there's what's unique about this algorithm, and it's truly unique, is that it not only gives you the entry point, but it gives you the exit point. So as you'll see on the screen here, it tells you how long to the length of the cycle in trading days. For instance, that first one there is 21 days. So when you're actually putting, all you need is the signals and an online brokership. And trading stocks these days is virtually, some systems like Robinhood, it's absolutely free to trade these stocks online. Other systems, it's only about $3 or $4 per trade. And you can easily put in the exit point. And then, as Meryl mentioned, you also sort of safeguard all of this by what's called a 5% stop loss. So if any of these trades don't go the way that we are predicting with our software, it's stopped within 5%. So you're gonna, you're not gonna, be losing.
You got to realize that.
And as Meryl mentioned, we've got the anticipated stock percentage here, the second to last column. You'll see that there's 11% anticipated profit margin on that stock. And then you've got the trade direction. These are both long and short. So, and then with the results that we're going to get to we've had this system up and working for all of 2018. So from the 1st of January all the way through to the end of December, we've actually got all the hard facts and figures. And when Meryl mentioned that there's been a 73% success rate, so when you take the stock signals that are indicating 13% or above, and you run the numbers on that, we start to get some very interesting statistics.
Roger, let me make a comment. So, yeah, there will be losses. That's the one thing you need to understand is that the 73% win rate or 64% win rate or 68 means that the opposite of that is how many that you're expected to lose, and that's why you need to have your stops in place. Right?
Exactly. Yeah. Well, Meryl, here's one chart that you produced from the 2018 results. So can you just describe what's going on here for folks?
Yeah, so essentially this is on each trade signal, and on the previous couple slides before on the email it says, okay, what's your anticipated percentage move? So with the moves that are 13% and above, this would be the graph if you took every single signal, every single one, and you put it in exactly as it's laid out. This would be the results. Now notice that this is so it's basically in this particular sample, it's just taking $1,000 per signal, right? $1,000 per signal, And there's about 4 or 5, or sometimes, I think we had one month, July, I think, where there were 0 signals. And then you look from August up through December, it had quite a run of success, all based, all pre, you know, and I don't know if you guys are aware of how the market did last year, but this is substantially better than the market. So there were about 49 or 45 trades for the year at 13% and above, with a 5% stop. And if you would have taken $1,000 per trade, this is what you would have ended up with, just under $3,000, taking every signal. Obviously, this doesn't come into take into account your broker costs, if you have any, and or your trade position. I mean, you know, I don't know what somebody's account might have, if they're trading 5,000 or 10,000 or 20 or 50 or 100 or whatever. This is just saying, oh, every single signal, whether it's a long or a short, take $1,000 and buy as much stock as you can with $1,000, and this and exit exactly as the email is. You know, maybe some people can do better. I don't know, but according to the software, and this is how the year would have ended up. This is non-leveraged, right? So it's just 1-to-1, and so, you know, that's pretty good.
Yes.
You know?
I think the figure on here was a 58% return, wasn't it, on these signals for 2018?
That's presuming like a $5,000 account that you would need to take $1,000 per signal, something like that. Then it would have been right around 58%.
Yes. Yeah.
Well, I think it's worth commenting about how we are able to have both entry and exit point, that by seeing the geometry of the long wave and whether the wave has enough amplitude in the price curve, then you know both the in and out point. So that's why taking a long wave is analyzing enough data over time, with fractality in time as it were. You get the shape of the wave starting to emerge into coherence from chaos. And so you know the shape of that wave, so you know in and out. It's pretty cool.
Yeah. So that's the critical part. That's actually, we kind of skipped over that, Roger. I wanted to go over that back a couple slides back. Can you go back a couple? One thing that's very different.
Which slide you're after though?
Stop at the emails. Go to an email. One of the emails, yeah. So one of the things that's really different about this that you won't find in a lot of places is we are telling you what your exit date and cycle is, you know, beforehand. So you know how long you're in it, right? Now you can do whatever you want, but I'm just saying exactly what Dan said is because of the, you know, and Dan, it's both longs and shorts that we're doing. Because we're able to analyze the shape of the curve, we know exactly when to get out. We know exactly what the times are. And we know that, hey, by this time, it should have hit it because we know what the peak amplitude is. Yeah. And we also know, hey, and so we take somewhere, you know, it's not always perfect. So our exit date's based off of a percentage of, you know, a half a cycle, right? So like you know, from 0 to 0 amplitude in the middle, we're getting out, I don't remember the exact number, somewhere around 3/4 of the way through. And by that time, yeah, we should know it should have hit that if the cycle was holding up. Now, cycles. Yes.
In other words, if the wave shape, the wave shape retained its coherence, and we now predicted the wave shape by the spectrum analysis, so we know up and down, which is to say in and out.
So that's pretty unusual and unique, and I actually think it's, having worked in the industry for a long time, full time as a professional for a number of years, a major hedge fund that we actually were the largest futures trader in the world in Chicago for a long time. And I built some, me and one of my buddies, we built some software that actually traded live there. This is actually pretty decent, pretty solid, pretty interesting for me as a financial and mathematics and computer scientist person, that we actually know when to get out, right? And so we can say, yeah, has this held up? Has it not held up? And that's why you should get out at that point, because whatever analysis that we have come up with, if it hasn't hit it, then that analysis doesn't hold up anymore. It's done, right? We're not just like holding on, waiting for something to happen. Our analysis is based off specific criteria, based off of this coherence and wave, wave coherence. So if it's not holding up, then yeah, we don't know what's going to happen, but we know for sure that it's not holding up to what we thought it would.
Yeah, so we know the duration of our prediction, and that makes it very helpful. Mm-hmm.
Yeah, well, and it's unusual.
Yeah,
that's a rare thing to find something like that in any kind of signal service or anything like that.
So Miro, this next slide is actually based on all of the signals. So just for clarity to the folks listening in here, we send you the signals and then it's your choice what you act on. So we're not financial advisors. We're just guys that have developed a fantastic system here for you to tap into the stock markets and to access it in a very, very easy to use manner. And then with the signals that you receive, it's up to you to choose. You might only want to act on a couple of a week or one a week or a few a month. It only takes a few moments to plug all of this in. But this chart here is based on looking at all of the signals with a 5% stop loss. Do you just want to comment on those results, Merrill?
Yeah. So I mean, this one, yeah, obviously it made a lot more money, but if you're gonna have to take every single signal, you're gonna need a lot bigger position, right? You're not gonna be able to take 20 trades a month, unless you have 20 or 30 trades a month, unless you have a lot more money. So that's based off of taking every single signal. One thing I was gonna say too is that this is showing the monthly. It's not showing every trade. It's just showing the months where we were at the end of the month after the trades. One other thing for people that actually already trade and whatnot, especially in that's kind of like what it would be if you had a $20,000 account. And this is non-leveraged. What that means is like typically when you're at a broker, you might get 2-to-1 leverage. So like if you have $25,000, then they will let you trade $50,000. But these results are only based off of trading exactly that 25,000, not a leverage. If you were leveraged, you would get double the results on that, for your equity position. And it's also non-compounded. So that means I'm not reinvesting any of the earnings back into the system. So that's very different for people that understand these things. That's very different than what you're going to see in a lot of graphs. A lot of these systems, they're going to reinvest their earnings back in. I didn't do that. I just put it straight up, non-leveraged, and with no reinvestment of the earnings back in. So that's a pretty lean. I mean, that's a pretty reasonable expectation minus whatever your trading costs are. And also it's a pretty non-aggressive chart compared to what, like if I built that chart, like a lot of the ones that you're going to see out there where they reinvest, compound the earnings, right? So this is a very non-aggressive chart presentation. I want to say one other thing. Hold on one second. For people that actually trade options, I really think there's a lot in here, especially if you take the higher percentage signals. You could really do some analysis on, hey, we know when the trade cycle is supposed to end. You could actually, I really think there's something into it if somebody took the time to look at those for themselves, trading options, and said, oh, okay, well, what's the volume on this particular option? We know when this signal is supposed to end. Buy it at the money, just under the money, a fairly interesting. So I'm just throwing that out there for any options traders. I think that you could probably find this useful. Yeah.
Sure. Well, look, that's great, guys. We've come to the end of the slides. Folks, you can see here, fractalwave.works. So we've got a website up. And we've got a lot of, statistics up there and some of the background, some of the concepts involved that we've discussed here. The subscription is very, very straightforward. You just go to the subscribe page and the first 30 days is absolutely free. So you'll be getting these signals for a whole month and you'll start to get the feel of it, and you can trade them, and and so forth. And then our subscription fee is $100 a month, which is a very, very competitive price for what we've got here. There's a lot of other platforms that charge a lot more than that. And it's just, I also consider this a very good way for people who, if you've never done any trading before, then this is actually a good way to start to get involved with the stock market, so because it's actually so user friendly, it's just a great way to start trading. As well, of course, for the professionals out there, this is another great tool that you could use in your arsenal. So, Dan, any final comments or thoughts before we go to some questions?
Well, I mean, the romance here of saying, oh, we know how to emerge from chaos, actually applying this commercially to the stock market. At first you say, well, you're kind of prostituting the romance of philosophy. But actually, if you want to be grounded in the world, we're teaching how to emerge from chaos, which is how to implode your aura, that's pretty powerful. But actually, if you can prove it financially, you're getting grounded. It's not a bad thing. And actually, money is a symbol for human energy. So it's not a coincidence that money flows in the same electrical way that energy flows. If it's really doing its job, it's neither good or evil. It's simply powerful. And you want to be powerful in the world. So it's applying the principle of fractality in the stock market is not prostituting spirituality. It can actually be grounding it and making it really useful and proving that you can be active in the world. So, philosophically, I still think this is a powerful thing. And I also would like to acknowledge Roger, because in the years of pursuing this project, we financed, the programming. Merrill did, many years of work here. And Roger kept at it, even when, other people who were investing here thought, oh, we can't bear this anymore. And Roger was dedicated. So there you go, Roger. I honor you. Thank you.
Me and 50 bottles of whiskey. There's our first question here. Can your system be applied to the trading of Bitcoin and other cryptocurrencies? Good question. I think in a quick answer to that, it's, correct me if I'm wrong, Merrill, but it's kind of like a different animal, isn't it? But what's your thoughts?
No, I mean, yeah, it can be. It can be applied. In fact, originally we had done the work on the currency markets, and actually, was it 2013, I think?
Merrill, you're going to have to speak closer to your microphone. We can hardly hear you.
Okay, yeah. So we actually did originally started with the currency markets because that was the area that I had worked in. And we did actually trade it live. I don't know if you guys remember, it was before Roger actually came on. We did have a currency system built in, completely automated and whatnot.
Yeah, no, that was with the Forex.
Yeah.
I was involved then, yeah.
Yeah. So, I mean, it does apply to that. I haven't done the work to do the signals and whatnot on that. It's a fair amount of work to do that, but that's the next step as we're going to go in that direction.
Yeah, so the theory of the wave shape analysis that would apply beautifully both to Forex and Bitcoin. It's just a matter of taking the time. And as we evolve this system, we may get there. It's a powerful thing.
Yeah.
Yeah. Okay, so there's another question from Sean here. Does the fractal wave theory give any predictions to broad-based markets like the S&P and the Russell 2000?
Mm-hmm. No. I mean, look at what the S&P and they all did this year, and look at what we did this year. Look at our charts. I mean, it's almost like they actually had a pretty bad year, a pretty bad November and December, and we killed it. Right?
Yeah.
There you go.
Yeah.
So we're leaving them in the dust, Sean. Okay, guys, so this is your chance to answer have any questions, but Merrill, just your final thoughts, if you like.
Merrill had something else there he wanted to say, didn't you, Merrill?
I mean, it can be applied to those ETFs and whatnot, right? I mean, it's the same principle. The principle is essentially exactly what Dan's been saying, is like, how do these things emerge, and is there coherence in the waves? Yeah, that's that can be applied to anything, obviously, right? It's
Pure
just,
wave analysis.
yeah, with financial, statistical econometrics applied, right? Applied mathematics with that. Yeah, so I mean, yeah, it's to me, as a mathematician, a computer scientist, computer architect, physicist, all those things. It's very interesting. This is actually, I don't know if there's any mathematicians or scientists in the audience, but this has been applied robustly and out of sample since 1982. So like when I did the analysis, I mean, I'm coming from a pretty rigorous background where we actually traded tens of millions of dollars on the systems that I created. So, I mean, they had to be like legitimate for me. And this is what I told them up front. No, it has to be legitimate before I would get behind this, you know. So I did the analysis from 1982, right? And built this only on 1 year of data and ran it across from 1982, and it held up. I mean, it's to me personally, yeah, it's pretty solid, right? It's a very, very interesting. If anybody wants to talk about the math or the way that it was analyzed and all that kind of stuff, yeah, I'd be happy to discuss that.
Well, Meryl, we will be, and for the folks out there, we will be doing some more webinars in the near future, especially now that we've got our results from 2018. So we're really confident about our software. We essentially were waiting, you know, the last year to see how, you know, it performed, and we're just over the moon with its performance. So we will be doing some more webinars, so we'll let everybody know about that. I strongly suggest, folks, that you go to the website and at least join up for the newsletters from fractalwave.works, because I've got several databases and I don't send out all the information to all of them about the fractal wave. So it's if you want to follow its development and be in the know, you know, sign up. So folks, I don't think there's any more questions that have come in. Oh, hold on, let me just check here.
I may make one more comment also about the discussion about applying this wave analysis to other variables like the Dow or currency or Forex or cryptocurrency. That part of the 10 years or so work on this algorithm that Meryl did was to optimize the thresholds for particular systems. In this case, the actual main stock market here, as opposed to Forex. So tuning those thresholds, is, as Meryl says, is another set of work. The point is we have a super powerful tool now, which is tuned to the regular stock market and which is ready to use. And as you help us evolve that, you prove it with us, then we will be empowered to move forward.
Well, there are actually two other questions here. So this is from Andrew. Will the system have an API to retrieve signals rather than receive via email? Well, at this, correct me if I'm wrong, Meryl, but at this stage, we feel that it's not necessary. The email system is working perfectly for people.
No, he's asking for another reason. He's not asking. He wants to use it in whatever way he's using it. Yeah, no, right now, I mean, we could, but no, that's, you know, that'll take some work, not a ton of work, but yeah, so that's what, I mean, if there's enough demand for it, eventually, sure, we could put it as an API, a REST API and all that.
Right. Well, here's another question.
It's all 100% cloud-based, so yeah, it's all out there in the cloud in Azure. So yeah, I could do it, but right now it's not, no.
Yeah, well, Andrew, in answer to your question, you know, perhaps in the future, you know, we've just got over our first hurdle here, where we've actually got it working really, really well. We've got a whole year of results, and we're just getting it out to the world and letting people know that you can access this. And obviously, we've got lots of thoughts of, you know, further development, and we'll be doing that, and we'll keep everybody notified through the newsletters. Here's a question from Sean. do you guys teach the actual theory or only provide recommendations? Well, sure, we only provide the recommendations. That's all we need to do. We're sending you the signals. Some days there's none, some days there's one, some days there's up to 3 or 4. And then you act on them the way you want to act on them. We don't do any further work. We don't advise what to choose and what not to choose.
I mean, in terms of the theory, fractalfield.com, origin of negative entropy, it describes the wave mechanics pretty accurately, but then how we've applied that wave mechanics to actually calculating thresholds in the stock market, obviously that's Merrill's work, and that's part of the background here. But the fun thing is the signals are easy to use, so there you go.
Yeah. The theory has been part of what Dan and I, Merrill, been developing for decades, which essentially described at the beginning of this webinar about the whole theory of the unified field, the fractal field, using the golden mean ratio, the whole fractality. We've got several projects. Some of them have even come to the market. For instance, the Therify device, which Dan and Paul Harris developed beautifully, is a plasmic healing device with sending a cascade of frequencies deep down into the body. It's a healing wellness device, but again, it's based on the golden mean ratio, and Dan's got the super imploder, an agricultural, thatimploder.com. It's been on the market for several years, and wonderful results with treating water. So we've been involved with the deep theory of the unified field and what we call the fractal field, and now for the last decade, Dan and I have been really focusing on delivering practical solutions to the marketplace.
Yeah, the theory's out there. The theory is what Dan just explained at the beginning. That's the theory, and then there's an applied way to go approach that with some practical things. And in addition to the all the thresholds and whatnot and tuning, there is also a fair amount of work for infrastructure, for setting up the automation and grabbing the data from the stock markets and all these things. So a fair amount of work. Yeah. Automate this system hands off. But the basic theory is what Dan said, and it's on the websites and things like that. There's an applied element that where you're going to go through and you're going to find and do the spectral analysis, the Fourier transforms, the sine wave, the extrapolation of the cycle lengths, dominant phases, all kinds of things like that. Some other things in there too, principal component analysis, etc., which actually a fair amount of work that way, all very mathematically sound. And robust, right? So there's real stuff in there, like just the real financial mathematics, robust statistical analysis, and also very robust software engineering to tie it all together, put the pieces together, architect and build the pipelines to the different pieces to where you guys actually get an email every day. Oh, this is all hands off, right? It's all in the cloud. And in theory, if it all works, which it does, you're getting these emails every day, and I'm not doing anything. It's all out there in the cloud, happening on its own, based off of all kinds of events that hey, it's in the stock market. Go check the data, pull it down, run through, pipe all this stuff into databases, run the analysis, find out who's subscribed, send the emails out, compile it, figure out, there's a lot of work that way done into it just to get the stuff out. But the general analysis is essentially the wave theory. Making it applied is substantial amount of work. Really, you'd have to have a lot of programming just to be able. You couldn't teach the stuff that I have in there. I mean, you could, but it's proprietary.
And it's 10 years of work by PhDs and cool people. But the other thing is there is a mystical side here that, the stock market is a big enough, quote unquote, chaotic oscillator that at times it emerges from chaos and behaves like a living, self-organizing being. And it's real, and it should, if enough people are focused on it. So that is a beautiful side of the story.
Well, great. Well, on those mystical final words, Dan, I'd like to thank Dan Winter and Meryl for our first
Thank you, Roger.
webinar. And as I say, folks, we're going to do a few more. And if you want to join up to the newsletters, we can send you some more information out about our 2018 results, which are just basically off the chart. And you can subscribe, get 30 days free. And then if you're interested, it's only $100 a month if you want to get into trading. So thanks, guys. And,
great. Thank you, Roger. Nice to see you, Meryl. Wonderful
to see you.
We're going to have more fun. All good.
Thanks, everybody.
Thanks.